Joining us right now is Ross Mayfield, investment strategist at Baird's Private Wealth Management. And there's not a whole heck of a lot of a dip here, Ross. Like, if this qualifies as a dip, I don't know.
Yeah, I think you're right. I mean, we came into the fall anticipating that, look, we had this great 3-month rally. We knew about all these headwinds, tariffs coming into play on August 1st. Now we have the Fed and the non-farm payrolls report kind of weighing. So expecting a bit more of a correction in what is already a seasonally weak period. If that does materialize, that to us would be a buy the dip moment, because I do think the fundamentals of the economy are a little bit stronger than the payrolls report lets on, and you still have the big tailwinds of the AI trade and all of the tendrils of that throughout the economy. So I think we're still in a pretty good place, but you're right. We'd want to see a little bit more weakness, maybe a bit of capitulation on valuation before we dive in head first.
What is that, a 5% pullback from here?
Yeah, I think 5 to 10 would be kind of what you might expect in a typical fall weakness period. We saw this a couple of years ago, even last year when the Fed looked a bit behind the curve when the SOM rule broke higher, and they ended up doing that 50 basis point cut. So fall has been a period where you get consolidation, you get some weakness, but we still think this is a cyclical bull market with legs to go. So I would lean in if we get that 5 to 10% correction.
Ross, are you rooting for a drop in interest rates from the Fed? Do you look at that as like, okay, great, this just means more fuel to the fire on all of these things? Or do you look at it as, they're going to have to cut rates because things are slowing down and we're concerned about what happens to the economy?
Yeah, it's absolutely the right question to be asked, because we've heard for years lower interest rates, lower interest rates, lower interest rates. But if the Fed is cutting because the economy is weak and we're heading towards a recession or a contraction, that's not good for risk assets. So I think the Fed, needs to lower rates. I think that's clear at this point. But I'm not rooting for weak payrolls reports to get there. That indicates something more fundamentally unsound with the economy, and that's not what we want. I think the economy. Look at the 80s and 90s, right? I mean, that bull market fueled by big tech, basically existed with the 10-year at 8, 7, 6%. So we don't need lower interest rates, 0% interest rate policy to have an economy and a stock market that works. And particularly not if we're getting those lower rates, because people aren't getting jobs.
Okay, let's talk about the tariffs, because we were just going through that with Libby. Look, tariffs, there are questions about what it'll mean for consumers. A lot of people kind of say, look, this is terrible. It's a tax on consumers. But we are raising money that the Treasury is collecting, and that's good news. A lot of people in the markets have said, hey, you needed to raise taxes somehow to find some way to pay down the debt. Now the president has brought up the idea of a dividend payout, or a rebate, basically, to consumers to say, hey, we're going to give you each, because we're making so much money, we're going to give everybody a check for, I don't know, $600, maybe, whatever that may be. Would you like to see that given back to consumers so they can put the money into the economy again, or would you rather see it used to pay down debt? Because I wonder what happens not just in the stock market, but also in the bond market if that money doesn't go to pay down debt.
Yeah, I think there will be maybe some ghosts of the stimulus checks from 2020 and 2021 and what those did to spark inflation if we start talking about helicopter money and sending money straight to consumers. Obviously, no one's gonna balk at getting a check in the mail that they can pump back into the economy. That would obviously do a lot for consumer spending and for nominal GDP. But I think on the flip side, it would have obviously an impact on the debt. And I think it would have an impact, most importantly, on the long end of the yield curve, because I think the bond market would view that as somewhat inflationary, somewhat pro-growth. Both of those things push long yields higher, and that is pretty much counter to what the government wants at this point, which is lower interest rates to help, borrowers, whether it's, in the housing market and the auto market, whatever it would be. So it could be good, but I think it would kind of be a little circular and a little counterproductive in the end, especially if the whole point is to raise money to kind of offset some of the taxes in the one big beautiful bill.
Okay. Ross Mayfield with Baird. Good to talk to you today, Ross.